In this module, we are introduced to the cost-volume-profit model. Now, in the last module, we talked about understanding our costs and how will they change with volume. We introduced a contribution margin. We will go over those concepts again and now look at it in terms of what kind of profit we can predict will happen if we know what our costs are. And we know what kind of volume of sales activity we need in the future. So cost-volume-profit is a study of the effects of changes of the costs as they change with volume and how that affects profit. It's very important for profit planning. It also helps management set selling prices, determine product mix and maximize the use of production facilities. There are 5 basic components. First, we have to focus on the level. What level are we talking at? Then we look at the unit selling price. Now the level could be sales unit selling price, the variable costs per unit and total fixed costs, and the sales mix. In a later module will deal with sales mix. Well, focus right here on the first 4 now. Notice when we talk about costs. Variable costs are expressed on a per unit basis. Total cost or fixed costs are expressed as a total. Now there's some basic assumptions here. Behavior of costs and revenues are linear. All costs can be classified in it into fixed and variable. All unit produced are sold. Now the first thing to do is develop what's called a cost-volume-profit income statement. Now we're not creating an income statement. We're taking the original income statement and reformatting it into those costs that are fixed and those costs that are variable, and then determine what the contribution margin is. The contribution margin is the revenue that remains after deducting the variable costs. So we're not changing income statement, but the way it is now, it is of little use to management. So we rearrange it. And this is only for internal use. Here is an example. We have Fargo Video, and the relevant data is and has a unit selling price 500, variable costs of 3, total monthly fixed costs of 200. They're selling 1600 units. So therefore, the contribution margin statement simply has sales minus variable costs, which then shows me what the contribution margin is, and the contribution margin is what's left over to cover the fixed. Once the fixed is covered, what remains is net income. So there you have the total contribution margin. Here we have, or we're going to look at the contribution margin per unit. Contribution margin is what is available to cover the fixed costs and contribute to income. Now the contribution margin per unit is simply the unit selling price 500 minus the variable cost, the unit variable cost of 300, which gives me a contribution margin per unit. So now I have, for every unit that I sell, in comes $500, out goes to cover the variable cost 300, and the 200 is left to cover my fixed costs. And therefore I look and I say, okay, my fixed costs are 200,000. Therefore, how many units will I have to sell in order to cover my fixed? 1,000, and that is break even, 0 profit. And if I sell 1,000 camcorders and I have a contribution margin of 200 per unit, then my total contribution margin will be 200,000 and my fixed that covers exactly my fixed, and the next one I sell. I have more contribution margin than I need to cover my fixed. So what is left after I cover my fixed is net income of the contribution. Then we look at the contribution margin ratio. This is very useful to us, and any time in business when you're talking ratio, it always means a percentage of sales. Gross profit ratio is gross profit as a percentage of sales. Net income ratio. Net income as a percentage of sales. Contribution margin ratio. Contribution margin per unit as a percentage of selling price per unit. And that way I get 40%, 200 divided by that. So now contribution margin ratio, you see, 40% will tell me exactly how many cause it I make 40% on him. Now, what would happen if I was to sell more than 200 unit increase or $100,000? Well, as you can see, if sales goes from 500 to 600 and my contribution margin ratio is 40%, then my profit is gonna go up 40%. I'm beyond break. Even so, my profit will go out 40% of that increase of the 100,000. So that's the usefulness of the ratio. Break-even analysis: the process of finding that point where total revenue equal total fixed costs, and it's expressed either as sales units or sales dollars. Now, when we talk about using the contribution margin technique to determine the break-even, then we want to find out what the total contribution margin is. And that would be a total revenues minus variable costs, and then relate that to the fixed costs. So now there are two techniques. If I'm going to use the contribution margin per unit, then my answer will be expressed in units. So therefore the break-even is the fixed cost divided by the contribution margin per unit, and break-even in units is 1,000 units. Now, if I sold 1,000 units at 500 break-even in dollars, sales dollars would be 500,000. But if I wanted to calculate that break-even in dollars, I take the fixed constants as I did before. But this time I use the contribution margin ratio 40%, and I will get the break-even in dollars. So to repeat, to get the break-even in units, you divide the fixed costs by the contribution margin per unit. To get the break-even in dollars, you divide the fixed costs by the contribution margin ratio. Here we have a company unit selling price 400, variable cost billions to 40, so the contribution margin that is 116, fixed cost is 180. Therefore, computer break-even in units using contribution margin per unit, fixed costs 180 divided by 160. And I get a break-even in units of 1125, so you can get useful. The contribution margin per unit is in the contribution margin ratio. Now that gives me break-even, which is zero profit. However, I'm interested in earning a profit. So the target net income, then, is that level of sales that I need to achieve in order to get that targeted income. And it's either expressed again in sales units or sales dollars. So therefore I need a total contribution margin to cover both my fixed costs and then give me 120,000, so I need a total contribution margin here at 320,200 to cover my fixed and 120 to give me my profit. And I'm going to make 200 contribution margin per unit that I sell. So how many units do I have to sell? Well, you divide 200 into 320,000, and you get 1,600 units. If I want it in dollars, I simply take the fixed costs again. Contribution margin. I'm sorry, to fix cost, plus the target, that income divided by the ratio. And I get my answer in dollars, so I can predict my profit at any level, or I can predict the volume one need to achieve any type of profit. Now there's one other concept here. Very important, and is called the margin of safety. Now this gives you an idea of the riskiness of a company, because the margin of safety is defined as the actual or expected sales that I am currently achieving or will achieve in excess of what I need to break even. So it's a cushion. If, for example, I'm selling 1,000 units now and I need 800 to break even, I have a cushion of 200 units. We don't express it in units. We express it in dollars, actually. But in this example, I'm using units. So if one company had a cushion of 200 units and another company is selling at 1,400 units and they need 800 to break even, they have a 600 unit cushions. Sales could fall by 600 units before they're not any longer profitable. So you can see by comparing what a company is actually doing to what it needs to do to break even, we can determine the size of the cushion, if you will. For example, how far sales can drop before they moved from a profitable to an unprofitable situation. Now we express this in dollars, and we express it as a ratio, so I can take the actual sales 750 and I look and I have already determined that the break-even is 500. Then my margin of safety in dollars is 250, so sales can drop 250,000 before I become unprofitable. But a better way to express that often is in percentage, and this is margin of safety ratio. And recall, our set of ratio is always a percentage of sales. So the margin of safety ratio is the margin of safety in dollars divided by the actual sales in dollars. And in this case, the margin of safety was 250. The actual sales 750. So the margin safety ratio is 33%, so the market can go down by 33%. Until you hit your break even. And so, therefore, it's a very useful concept. So there are a number of concepts in this module that you must again be very familiar with. Contribution margin in total contribution margin ratio, contribution margin per unit, target that income, how to determine that, and the margin of safety. Now, many problems you're going to have and you have to do some analysis to. The trick is to focus on contribution margin. Those three: contribution margin in total contribution margin per unit contribution margin ratio.